I'm Cleb Messador, Executive Director of Blockchain Foundation, and you are watching Taking Stock.
Counting down to the close. Today is Friday, October 3rd, and this is Taking Stock. I'm Ashley Mastronardi. So excited to host you for the next 30 minutes. Lots of news moving the markets today. The Dow broke 47,000 for the first time ever, while the S&P 500 hit another record high. Palantir falling over 6% as an internal U.S. Army memo described one of its battlefield communication systems as fundamentally flawed. Goldman Sachs CEO David Solomon seeing the U.S. economy accelerating into 2026. He believes AI investment outweighs challenges from a softer labor market and geopolitical uncertainty. Today on Taking Stock, we're going to catch up with Peter Tuchman of TradeMoss, Stephen Sykes of Public, and Rob Petrazzo of Rally, plus an interview with Jeff Yersisin of Grove Collaborative, and the latest from Money 2020, Scarlett Sieber. We are about to get to that bell. Future Crest Acquisitions is doing the honors for the close. They are here to celebrate their recent IPO on the New York Stock Exchange. Let's go to the bell. Let's take a look at the major indexes as the market closes. The S&P 500 is fractionally higher. The Dow Jones is up about 0.5%. The New York Stock Exchange Composite also up about 0.5%. And the Russell 2000, which recently hit a record, is up almost 0.75%. Joining us now is Peter Tuchman. He is the senior floor trader at TradeMoss. How are you doing?
I'm okay. I've never held one of these before. This is fun.
The Einstein of Wall Street. It's always such a pleasure to talk to you. Let's talk government shutdown. Markets resilient. S&P closing the highest ever. Yep. A record for the Dow. What are the markets making of this shutdown?
You know what? Look, it's pretty amazing that normally, historically, when we've had these, every year, they always sort of take the market shutdown to the witching hour, and then they make a deal at the end. This time they had no interest in doing that. The market, for some amazing reason, is not engaging it. Although midday, there was a couple of votes that went on in Congress, and it did put a little pressure on the market. But we bounced back. We're closing out. This is the first week of the fourth quarter. There is a lot of fresh money coming into the market. We're seeing large buy programs come in. The market doesn't seem to be engaging the shutdown now. That may change. The longer the shutdown stays shut, it's going to start to impact GDP. We saw that Mr. Besson, advisor of the president, said that if in fact that it stays shut for 3 weeks, it could have a massive It could have a massive impact on GDP, actually as much as 1%. So if it shuts for 3 weeks, that's going to be a major thing. So right now we're not seeing a lot of impact on the market so far. We are closing out the first week of Q4 at record levels.
All right, the Dow hit 47,000 for the first time.
No way, I have a hat. Oh my God, an intraday high, that's great.
Intraday high. Do you think we're gonna see the rally continue, Peter, into the end of the year?
You know what, look, I'm not here to predict where it's going to go. It feels like it's building a foundation to go higher. Now we know we could be one tweet away from complete crazy town or any number of things, but whatever the market has been thrown at this year, and in 2025 we've seen absolutely everything, the high highs, the low lows, that sort of mini crash that we had February, March, and April, the market has been incredibly resilient, right? We've got a couple of wars, we've got tariffs, we've got so much going on, so many moving parts in this economic mechanism, yet the market continues to go higher. So that's a function of a lot of different things. A lot of money on the sidelines, underinvestment, funds and stuff playing catch up. Earnings have been solid, guidance has been good. So my gut is we're going to see a 7 in front of the S&P. We could see 48, 49,000 on the Dow, and we continue. This is the 33rd record close in 2025. That's extraordinary.
All right, what we don't have going on though is the jobs report that was not released today because of the government shutdown.
Correct.
How do you think that's going to affect the Fed's decision in their October
You
meeting?
know, look, at the end of the day, they're going to have to find out what the real numbers are. My hope is that it's not going to last that long, right? That number is pivotal, right? We know that Mr. Powell's decision making is based on economic data. Without that number, I mean, he's going to be driving in the dark, right? Net, I'm sure he'll be able to make and navigate his way through that, and we'll come up with a number. We know that November and December we've set the stage, 4 cuts into then. Whether we're able to come up with a number, with a cut for October, yet to be seen.
What are your predictions for October? What do you think is going to happen?
You know what? Look, I'm not a fan of seasonality. You know, I think so far October has shown us that there's a lot of strength in the market. We've got deals on tariffs. We've got, and even in the eyes of an economic a government shutdown, the market continues to go higher. So I can't predict what October is going to be. Historically, look, we had the crash of '87. I was here as a teletypist in 1987 when the market had its second largest loss in history. That happened in October. The market has a bit of a muscle memory. October can be seasonally weaker, but you know what? I don't think that's going to happen.
All right, Peter Tuchman, Einstein of Wall Street, Trade Moss, thank you so much for joining
Absolutely,
us.
my
I'm going to
pleasure.
go take a walk right now.
You do that.
Okay, we're going over to the NYSE Notables. Let's take a walk. My favorite part of the show. All right, hi. Oh, excuse me, coming through. Hi, Dexter. Hi, Dexter. Okay, it's always a party when that closing bell rings, and the opening bell is really fun too. You can watch our show NYSE Live, 9 a.m. on our social channels. Okay, we are checking out some notables. First is Lithium Americas. I recently actually interviewed their CEO, and they had a really, really exciting week. The company confirmed that the U.S. Department of Energy is going to be taking a 5% stake. It's also going to take a 5% stake in its Thacker Pass project with General Motors in Nevada. The agreement is linked to a $2.2 billion Department of Energy loan package and is designed to expand domestic lithium production and support electric vehicle battery supply. Shares of Lithium America surged more than 30% after the announcement. For Wall Street, this is energy security meets industrial policy. Next up, we're going to look at another notable, Teladoc. They are a telehealth provider. They climbed 6% as Citron Research put out a bullish post about it on X. Citron Research has been taking a couple of long positions over the past few months. Citron saying the latest time Teladoc's Livongo program was this strong, the stock was at $15. And with this rally today, Teladoc is now higher year to date. Okay, so we're going to go to a package now. Last week, our very own JD Durkin caught up with CEO Jeff Yersusin of Grove Collaborative. Take a look.
Grove Collaborative is the first retailer to measure and publicly disclose the carbon footprint of its own AI use, which currently accounts for about 6% of its 2024 business travel emissions. And join us now to break it all down, talk about that and much more, is the CEO of Grove Collaborative, Jeff Yersusin. Jeff, welcome back. Nice to have you here.
Thank you. Good to see you, JD.
You've said that Grove must be sustainable before it can transform the industry. Talk to me about the early pain points that you sought to address, that you actually sought to fix as well.
Well, there are probably two different themes here. One theme is, as a business, you have to have a sustainable business to achieve your sustainability mission. So you have to be profitable, you have to be growing, you have to deliver a customer experience superior to anyone else. And that's what we're doing. We are the destination for clean, sustainable, non-toxic products. We are the first plastic neutral retailer, and we're a certified B Corp. But at the core, when we think about AI, we don't think that businesses should have to choose between innovation and sustainability. I believe the future demands both.
How have supply chain shifts, even in just the last, let's say, year and a half to 2 years, 24 months or so, changed your overall sourcing strategy?
That's a good question. So look, the supply chain shifts, like for instance, some of our best products are bamboo kind of tree-free products. And a great majority of the bamboo is actually manufactured in China. So we've had to figure out how to find the fastest, most nimble supply chains possible to serve that end consumer. So there have been, changes from a supply chain perspective, but that is not the real driver of our underlying performance. Our performance ultimately comes down to, can we deliver a customer experience that is superior to any other customer experience for a specific customer segment? We believe we can. We think there are about 57 million conscientious consumers who just want products, someone to curate products for a healthier family and a healthier planet.
Jeff, if I'm not mistaken, since the last time you and I spoke, was the rollout of so-called Liberation Day back in April, and I wonder if to just kind of continue on with this, the supply chain unexpected headwinds that 2025 has brought. Can you kind of revisit that time period for us, and what were you seeing in terms of conversations? Because I'd imagine for so many key businesses like yours, it's the forward-looking guidance that was probably very difficult to try and get an accurate sense about the true cost of goods that might be imported. What did kind of Q2 look like for the company?
Um, I appreciate that. Like, look, I think all businesses have to find paths in the middle of uncertainty. And yes, when supply chain and costs have a potential of varying quickly in a short period of time, we need to be nimble. But I think, again, I go back to what we're trying to do. And what we are trying to do is not to imitate other D2C players, but to build a unique experience for customers that they can only find with us. And so, this week, I don't know, um, we are the first to publicly disclose AI related emissions and integrate them into our scope 3 reporting. Like, this is something no one else has done. And it all started with a question from an all hands from one of our colleagues, teammates. And then we've been running down this path to kind of make sure that we are able to deliver on our mission of being the sustainable company while leaning heavily into AI, which I see as a more positive disruption than any supply chain type of impacts.
Jeff Yurgerson is the CEO of Grove Collaborative. Jeff, very grateful for your time as always. Thanks a lot for joining us. Congratulations on all the success already, and best of luck on the road ahead. Jeff, thank you.
Amazing. Thank you so much, JD.
Time now for a few fintech, crypto, and AI headlines. First, crypto major players Bitcoin, Ethereum, and Solana all finished the week in the green, rebounding from a previous dip. Next up, BlackRock is closing on a $40 billion deal for aligned data centers, betting that AI demand will keep fueling a global data infrastructure boom. Finally, Walmart's OnePay will soon offer Bitcoin and Ethereum trading on its mobile app, partnering with Zero Hash to handle store purchases and card payments. Earlier today, I caught up with Steven Sykes. He's the Chief Operating Officer of Public. Public is an investment platform that's now making it easier to invest like the 1%. Take a listen. Direct indexing used to be something available to only the top 1%. Now for $1,000, the average investor can build their own direct index instead of investing directly in an ETF. Joining us now to break this down is Public COO Steven Sykes. Steven, welcome to the show.
Thanks for having me. I'm happy to be here.
So direct indexing mirrors what some people want from an ETF. Can you explain the difference between the two?
Yeah, so I think there's some similarities and some differences. I think it's very similar in that you aim to match the performance of the index, right? You're going to own the direct index, or you're going to own an ETF. You're trying to match, for instance, the S&P 500. And again, that's one of the largest indices that we're seeing people invest in. But again, you want to get that same sort of index performance. And then similarly, you're paying fees to a manager, right? For the S&P 500, it could be you're paying fees to iShares, BlackRock, or Vanguard, right? In this case, you're paying fees to sort of, Public's investment advisor, and we're helping you manage that full position. So those two things are very similar, but there are four big differences. One, when you directly index, you get to customize what's in that index, right? So yeah, you want to own the S&P 500, but maybe you don't want to own oil and gas, or maybe you own a bunch of Tesla in another account, so you want to own a little less in your index account. So you can sort of adjust those holdings or remove the holdings that you don't want and really customize what you're looking for. The second big thing is tax optimization. When you own every individual position in a direct index, which is again how it's different direct from owning the ETF, which is just one position, you're going to own all of the positions in the S&P 500. When you do that, you both get individual positions that go up and some that go down, When those go down, you can generate capital losses, which are used to offset future gains and ultimately improve your after-tax return, which is what we all want. We want to have more money at the end of the day. We want to get a better return from the things we invest in. The next, so big difference, you also own each of those underlying positions, like I said, but you get the shareholder rights that are associated with that. So you can vote your positions, you can participate in any shareholder lawsuits and any potential returns that come from those, which are things that happen and that you may not get if you own the position directly, through an ETF. And then the last thing is, obviously there are minimums and those are different, right? And so what you exactly invest in depends on how much you're investing in across the index. So for public, again, like you said, it's a minimum of $1,000 across any index, but that might not get you all 500 positions in the S&P 500 because we have to manage the individual position sizes. Whereas when you own an ETF, it's just whatever the ETF costs in the market.
And why have high net worth individuals traditionally use direct indexing?
Yeah, so I think it's what I alluded to in the first answer, which is it's just a better way to own the index in that you're likely to get better after tax, better after fee returns than owning the equivalent ETF. And it's just that, that was a strategy that you needed to have a lot of money to pursue prior to really public coming on the scene and launching it, with as approachable a minimum as we've been able to do.
All right, and how does this work on Public's platform?
Yeah. So, generally speaking, it's, you invest in an index, right? You pick which index you want. You're going to get the full list of positions, and how many of those positions you are going to be able to invest in depends on the specific index and how much you're investing. But again, any index you can invest in sort of the top holdings for as little as $1,000, and really in most cases that's actually going to give you quite a close tracking to the index that you want. As you get further down in the S&P 500, owning the last 100 positions is a really small percentage of the overall S&P 500 because of the way they do the weighting. So again, you get, even with relatively small initial investment, you're going to get quite a wide exposure to the index, and we can do that, different from sort of historical direct indexing, by investing in each of those positions fractionally, right? So you don't have to buy the full share, you can buy just the dollar amount that you want.
Public COO Stephen Sykes, thank you for joining us on Taking Stock.
Thanks for having me.
Welcome back. Today in Startups Raises and Rounds. First up, startups face new uncertainty from the government shutdown with visa processing frozen, deal flow slowing, and regulatory approvals at risk if it continues to go on. Next up, Meta is reportedly in talks to buy Revos, a Santa Clara AI chip startup, as it looks to cut reliance on NVIDIA and boost its own data center capacity. Finally, security compliance startup OneLeap has raised $33 million to expand its AI-driven platform. Okay, so we're going to go to an interview now. I'm joined by Rob Petrazzo, co-founder and CPO of Rally. We were talking before, super interesting what you're doing. Take me through what Rally offers.
Yeah, so Rally is essentially a stock market for collectibles. So we do little IPOs and individual assets. So it's everything from dinosaurs to Birkin bags to first edition technology to copies of the Declaration of Independence, all these assets that typically are reserved for the super wealthy, but we allow people to invest in them fractionally at around $10, $15 a share and then trade them on our secondary market, very similar to the way that you would trade stock on the stock exchange.
How did you come up with the idea for this?
I mean, this is something that myself, my co-founders, we've always been sort of collectors of everything, but inevitably, I think when you're young and you're trying to sort of put some money to the side, you can't get the best stuff that's always reserved, that's literally behind the velvet rope. We want to have a way that people who really cared about these assets and these are the items that they love can get real exposure to it. And it kind of led us to building this out over the course of the last 7-8 years to the point that it is now, where hundreds of millions of dollars in transactions and some of the most expensive, most valuable assets in the world are on the platform.
And I understand you have a Barosaurus offering,
yes,
which is worth over $12 million right now. Tell me about that, and how can people get in on that Barosaurus?
Yeah, so we got access to one of the biggest dinosaurs ever sold. It'll likely end up as the biggest dinosaur ever sold. It's in the excavation process right now. It's a $12.5 million dinosaur. Like you said, there's 200,000 shares, $62 a share. What we did is we worked with a great paleontology and geology team out west in the Morrison Formation, where some of the greatest dinosaurs are found. They're about 75% of the way through the excavation right now, so investors who come onto the platform, go to rallyroad.com or go to our app in the App Store, get access to a full investment prospectus, to get all the information about the dig, about the bone count, about what we think it will be when it's finally done sometime in mid-2026, at which point all investors in that IPO will be part of us bringing it to auction or finding a private buyer at hopefully a significant price and potentially one of the most valuable assets, most valuable dinosaurs ever sold.
And what type of investors are you attracting? Do you think there are people who are really into collectibles? Is it people who are new to the space who just want to learn more? Who is like your average investor?
Yeah, that's actually the most interesting part. When we started this platform, we thought it would be the purists and the people that are living every single day in the nuts and bolts of every individual item. But what we've seen is that you have a really sophisticated young investor who's finding their way to our platform, very similar to the investors that are on Robinhood or on Coinbase that are trading crypto. They're looking for something where it's a hard asset to be a complement to the rest of their portfolio. And when they get into the app like Rally, this 25 to 35-year-old, they find something that really resonates with them. They do all the research, and they're making really significant purchases and investments with conviction, the same way they would if it was a stock like an IBM or like an Apple, where it's part of their everyday life. We've seen them add this to their portfolio with the same conviction that they would any equity or any crypto as well.
All right, and can you share with me your, 5-year, well actually no, you're talking about your investors being interested in crypto and you're getting into tokenization.
Yep.
Can you talk more about that?
Yeah, I mean, that was inevitable for us, ever since 2021, during that NFT craze, when the idea of putting things on chain became way more prevalent in all of our conversations we were having with our investors, when we were raising money with everybody in the ecosystem, we knew this was inevitably where we would end up. Now we have the ability, and we will be, with a portion of this Barosaurus, bringing it on chain with a couple of our partners. We'll be announcing that next week to promote it to other platforms so you get real liquidity out of the secondary market.
Where do you see your company in 5 years?
I think we want to be in a place where anything that you see that you love that has value, you can come to Rally and make an investment in it and put that equity in your portfolio. We want to have that live next to your stocks, next to your equities, next to your 401k. We want it in every single portfolio the same way that equities are.
How sound are these investments? Are they on the riskier side, the safer side? Like, how would you gauge them?
Yeah, that's part of why we put this platform together, is that you have all different risk tolerances for all different assets. So there are blue chip assets, things like early edition Porsches and sort of Birkin bags that have that steady rise. Then there are others that are a little bit riskier. that, like these dinosaurs, where we don't know where the bone count's going to end up. If it's at 80, 90%, it's one of the most complete dinosaurs ever found, then it's a really significant investment, significant find that we had. But at the same time, there's always risk with all these assets. Hard assets tend to outlast in situations where everything's going a little bit crazy. But for us, this is something that we feel like long-term, all of them are the assets that we would invest in personally.
Oh, okay, great. Rob Petrasso, thank you so much for joining us from Rally. Super interesting.
Thank you.
Really interesting. So after the break, the latest from Money 2020's Chief Strategy Officer, Scarlett Sieber. Don't go anywhere. We'll see you in a few minutes.
Welcome back. I'm Scarlett Sieber from Money 2020, and today we have a special segment called The Breakdown. We're going to be breaking down Snowflake. Why Snowflake? Well, they may have been in the building here. You can still feel the presence all across the floor. So let's talk about them for a second. Snowflake was founded in 2012 by data veterans with the vision to reinvent how enterprises handle data. Data is the hottest thing, as we hear all the time these days, and if I had a shot for every time people were talking about data, I would be underneath this table. If data is the new oil, then Snowflake has built the ultimate efficient and safe storage system for it. Snowflake has had quite a journey. Their current CEO, Ramaswamy, has been there since 2024 and is really shaking up the game. They've continued to push forward with new partnerships like with Anthropic, an AI firm, to bring AI capabilities deeper into their data cloud. They've also raised their forecasts and doubled down on AI features, which could push usage even higher. So what makes them unique? Number one, pricing. Elastic consumption-based pricing means customers aren't locked into unused capacity. You pay for exactly what you use. No more subscriptions. That's a big deal. Silos is an advantage. Separation of storage and computer power, which gives flexibility and efficiency. The ecosystem, the network data sharing and marketplace, which allows customers to buy, sell, and share data sets powered by Snowflake's infrastructure. And also, they're ecosystem agnostic, which means that they run on AWS, Azure, Google Cloud, etc. So they're not beholden to just one cloud provider. Essentially, Snowflake doesn't charge subscription because they're not the classic software. They charge you for what you use. Compute, storage, data transfer, and extras, all tied to real usage. They've raised billions with their IPO, doubled in valuation immediately, and now are pushing into AI and data monetization. What makes them fascinating is how they bridge cloud infrastructure, analytics, and data commerce. In a way, they built a fintech-style engine around data. Data as a currency, usage as billing, markets for buying and selling data. So if you're thinking of them as just a cool data cloud, consider this. They're redefining how money flows through the data. And with that, that's your breakdown.
That's going to do it for us today on Taking Stock. An exciting week for the markets. The Dow hit an intraday high. It broke 47,000 for the first time, and the S&P 500 also hit a record high, going over 6,700 for the first time. Let's just take a look at the markets. S&P 500 up fractionally. The Dow is up about 0.5%. The New York Stock Exchange Composite about up 0.54%, and the Russell 2000, which recently hit a record, is up almost 0.75%. So that's going to do it for us on Taking Stock. We will see you Monday. Have a very happy Friday. Have an amazing weekend. And JD Durkin will be back on Monday to bring you the latest news.